I'm Evan. I am the COO of Better Bookkeeping. For all of you guys who don't know me, we are a bookkeeping software and tax company. We do books and taxes for our clients. So we're kind of an end-to-end solution. Mitchell is our co-founder, and I'm sure most of you are here because you know who he is. But Mitch, if you want to introduce yourself real quick.
I'm Mitchell Baldridge. I'm a CPA and financial planner. I am a partner and founder of Better Bookkeeping. We've built a kind of end-to-end uh, bookkeeping, tax planning, and tax preparation uh, firm for business owners like you. And
Um,
so, yeah, take it away.
Yeah, so I mean, this session we're really focused on what are the things that I think everyone's been feeling a sense of relief since taxes are over. A lot of people have still not filed their taxes, but we're beyond the 415 deadline, and now we're gearing up for 915 and 1015 for those who've extended. But in any case, we want to lay out of the things that happen throughout the year that make you a good tax citizen, maybe alleviate some of the tax stress that you felt last year coming into this year, and then also talk about the new big beautiful bill that's coming potentially out. I know that's been really interesting for folks, and we've seen a lot of questions out in the world. So just trying to see if we can offer any clarity on what could potentially happen. So we're going to start with that, and then dig into some of the things at the mid-year as tax experts. What would we be doing if we were put on our best tax hat and do the things that are best for the business?
Yeah, so like you said, we just made it through the tax season, hopefully, or we haven't started on the tax season and we're still in 2023. But for our clients, we are caught up and we are thinking about closing out the quarter. We're thinking about June 15th estimated payments, and we're thinking about kind of what ifs and scenarios and planning scenarios around this new tax bill that might be coming out one of these days. So, yeah, excited to run you all through it.
This is something that we talk a lot about, but what we're trying to do is get in front of the February conversation where you can't do anything. We get that, call from folks. It's like, hey, what can I do? What can I save on taxes? And it's like, okay, well, what did you do last year? And I'm like, oh, I don't know. I extended my taxes are extended, and you're like, great job, but there are some things you have to do before the end of the calendar year. So those are really the things that you want to get in front of and not be having this conversation in, November, and worse yet, February.
Yeah. So, yeah, zooming out, the core thesis of the better bookkeeping product is that what if you could put the entire tax planning, tax preparation, uh, annual checkpoint system on rails? Meaning, so many people just say, "Oh, my accountant's not proactive. They never give me advice. They never tell me what to do." And it's a perpetual problem in the industry. Well, no one's that excited about bookkeeping. No one really wakes up and goes, "Oh my goodness, I want to get my books kept today." But that is the core foundation in our system of the layers of get the bookkeeping right, get the month closed out, understand the financial performance, and then be able to advise on things like entity structure, tax opportunities, retirement planning opportunities, tax payments, et cetera. So, yeah, the core thesis of this business is, yeah, getting on that call in February and telling somebody everything we're going to do to save them, and them saying, "Well, what about last year?" And we're going, "Well, last year's over, so we can only look forward." So we're glad you're here. Oh, here's the big danger, proceed with caution. Basically, I'm a CPA, I'm a financial planner. I might be your CPA on this call, but but maybe not. Hope that you'll become my client. But until then, This call is for entertainment purposes only. This is not financial advice. My lawyer made me say this. Do not get on a webinar and start taking financial advice from anybody. We'd love to work with you. We'd love to give you more personalized planning, but for now, we're this is information.
Yeah, and just one more thing, just to note back, I said this at the beginning, but for all you guys have continued to join, we have a Q&A button in here. So if you have questions as we go, feel free to raise them and we'll try to answer them either on the spot or in the chat.
Nice.
So jumping into the news, everyone loves, I'm sure, all the exciting things that are happening, or not, but there are some interesting pieces for this new tax bill and just kind of understanding what those could look like, if the bill goes through. Um, it's raised a lot of questions for our clients. And so we wanted to start today with kind of going through some of the boiler points and lay it out. Again, this is all assuming this goes through and there's lots of assumptions here. But there are some pretty interesting changes that could be happening.
Yeah, we know sex sells over here, so we're leading with the hot new bill talk, and so, um, but this is obviously, uh, the new tax bill. We hadn't had legislation like this since 2017, and really before that, since 1986, and the 1960s. I mean, these are humongous changes and how taxes work today. And we've had time. The bill's now made it through the House. It's sitting in the Senate. It's obviously very much subject to change and very much subject to horse trading and you know pork swapping and all. There's people who are happy about some of it. Most people are unhappy about big parts of it. But what you're left with today is a lot of the big beautiful bill was promised to enact and make permanent a lot of the 2017 changes. And on the individual side, it does a lot of that. It is taking these brackets and extending them permanently. It's taking these standard deductions and indexing them and extending them permanently. It's trying to push the child tax credit, trying to allow you to do, the other campaign promises were no tax on tips, no tax on Social Security, no tax on car loans. Those all are not really made permanent. The issue is, just going into uh, how a bill becomes a law. I'm just a bill on Capitol Hill. They're trying to push this entire bill through budget reconciliation, which is what they did in 2017. And so they use this thing called the Bird Rule. And so the basically committee, uh, the joint budget committee has to score this bill and determine that over the next 10 years, it's not going to raise the deficit beyond what they've bargained that it will raise it. And so they're limited in making a lot of these changes permanent because it's just too expensive. So they're looking at a lot of 4-year changes. Now, they're going to go argue about how the bill gets scored. They're all going to swap out, you know, what benefits are out there. But, on the personal side, they are trying to permanently extend, a lot of these benefits that were pushed back. Now, 2026, if there's no new legislation, it's going to be a massive, massive, massive tax increase for Americans. That's frankly probably untenable for Democrats or Republicans. Like nobody really wants it. So my judgment is that something's going to get done. I mean, it's through the House, it's in the Senate. The Senate has a majority that they can pass the bill through reconciliation. But you know, they don't need 60 votes. They just need the 51 votes. They have the votes so long as everyone agrees. So I think again, everyone's going to be pretty unhappy. So then going to the business tax cuts, they're kind of mostly all through um, 2026. QBI deduction, that they're talking about it going to 23%. They're talking about the specialty service trade business rules getting more and more convoluted. The other thing that this bill does is generally makes taxes more complicated. It's the Full Employment for Tax Professionals and Tax Planners Act. you know, hopefully AI comes in and makes your taxes simple and you don't have to worry about it anymore. But I mean, the value of tax planning, I'm talking my own book here, but the value of tax planning for high income folks and for business owners is going to go up and up and up because the rules are just getting more and more complex. So the salt deduction cap is going up. Today you have a $10,000 limit on the deduction that's supposed to go to 40. But then again, the phase out's going to happen. So high income folks, it's going to take it back to 10. It's bad for specialty service trade businesses, the way it's written today. And the pass through entity tax for business owners out there today might go away. So in these high tax states, these coastal states, it could end up being a worse outcome. But again, a lot of this is up in the air. Bonus depreciation, that's back. I'm excited about that. We were told it would be permanent. Now it's only through 2029, and it's not going to phase out the way it's been phasing out today. It's just going to drop to zero. Um, Manufacturing is probably the biggest winner in this whole bill. There's lower rates being proposed. There's still the DISC Corp that's out there, the Domestic International Service Corp, where manufacturers can get over lower rates for sending product overseas. But then beyond that, they're taking the real estate, the manufacturing facility that's out there, and making that 100% bonus. So, they want to MAGA. They want to make America great again. And part of doing that is bringing production into America in a way to increase, you know, the capitalization of all this production, the investment in all this production is to give people tax breaks. So, you know, and the other big thing that happens is, the estate tax was set to drop down to 5 million index for inflation. It's set to permanently go up to $15 million per person index to inflation forever. That's a pretty bipartisan issue. A lot of Congress people are rich and don't want to pay a state tax on their fortunes.
Quick note about SALT. Just explain what that
Yeah.
is.
SALT
Interesting.
is the state and local tax. Thank you for that. So basically, like I'm in Texas, we don't have state income tax, so we can deduct our real property taxes. We have expensive real estate taxes, but like in California, up until 2017, if you had $40,000 of state income tax, you could deduct that for federal purposes. Well, you know, all the folks in Washington started saying, well, why is the federal government giving this allowance to California and New York and these high income tax states to be able to ratchet up their state tax and have their citizens, their residents benefit from their higher taxes from a federal perspective? Why are we underwriting these states that can't seem to get their spending and budgets in order? We're going to disallow the deduction of that state income tax out there. And then this pass through entity tax thing started happening state by state by state, where the states started saying, okay, we'll just pay your state income tax as a business expense, and then we'll give you a credit for it um, on your business tax return, and then we'll give you a credit for that payment on your personal return. And so, most of tax is just a whack-a-mole of incentive, lever, poison pill, get around it, fix the get around it again, fix that loophole, so that's what's happening. It's a story as old as time. Someone said, "Will we get the recorded video later?" Yes, you will. It should be this week. We'll turn it around pretty quick and ship it out to everyone.
It's also gonna have, obviously, the content in the slide, so and this is a lot of information to consume, here with this side-by-side chart, so realize that, and you may wanna come back to it later. So we'll be sending out the slides and everything so you guys can always reference it back. All right, we're gonna leave the world of potential and go to the world of real. So as a small business owner, what should you, assuming you are a small business owner, what should you be doing now? Um, because as Mitchell mentioned earlier, it's June 3rd, taxes are due June 16th. So quarterly tax estimate payments. So if you need to pay on a quarterly basis, which if you own your business, you should be doing. We are actually in the process right now of knocking these out for our clients and sending them so that they have time to get in front of these tax estimates. But we have some things to kind of like lay out for you if you've never paid an estimate or you're unsure what to do. We'll kind of talk through some of those things.
Yeah, so and I told Evan, I said, "Oh, we'll tell them all that we're doing that right now." And she goes, "Well, we've done like most of these already." And so for our clients, again, when everything's on a system, when everyone's using the same standardized chart of accounts, when we're posting transactions on a daily basis, when we're closing out months in a really orderly fashion, we get to kind of get to this. And when most of our clients have already filed their taxes, like we're not extending most people into October at Better Bookkeeping. We're able to kind of get these things done quickly. So essentially, quarterly taxes are that the government doesn't want you to hold on to their money for any longer than you have to. The government sees a portion of your earnings is their money, and they're due it, you know, on
Upon
a quarter
receipt.
by quarter basis, ASAP. I mean,
Yeah.
so for W-2s, you withhold, meaning that the government gets the money before it even hits your bank account, and that's ideal in their view. You know what I mean? Don't even give these people their money. Don't let them see it. There's that old joke that like if people had to walk to the water cooler every Friday and peel off 32% of their money and hand it to a government agent, we'd have a revolution pretty quick in America. And business owners feel that more than most people in the sense that you get used to scratching out really big checks every quarter. So, but how quarterly tax estimates work is there's this safe harbor method. So you either have to pay the lesser of 100 or 110% of the prior year's taxes, depending on your income level, or 90% of current year's taxes. So, in that respect, if you're in a business that's doubling its profits every year, meaning you're up only, your income just goes up every year, you're able to peg the amount of money that you need to pay the government based on the amount of money you made last year. So if I made $400,000 in 2024 and owed $100,000 of income tax, I know that I just need to have $110,000 paid in based on my estimated payments in 2025. And so that scales up forever. If I win the $1 billion Powerball lottery this year, I know all I have to do is pay 110% of last year and I'm safe. I can hold on to that money and I can sit there and earn interest until April 15th of next year, in which case all of my taxes due, you know. And if I pay less than my total tax burden, within $1,000, that I'll start being penalized and charged interest and all this stuff on the money. So even if I win the Powerball and I win $1 billion and I pay 110% of last year, I still have to hold on to that money because I know I'm going to need to pay it, but I get to earn interest on it in the meanwhile. Well, if my business is shrinking, um, then I'm going to use this 90% number, meaning throughout the year, I'm going to at least need to get 90% of my current year's taxes. So let's say I made $1 million last year and paid $350,000 of tax, but this year I'm going to make $400,000 and owe 100,000. Well, between April, June, September, and January 15th, these four payments, plus all my W-2 withholdings and any other ancillary withholdings, I'm going to need to get $90,000 of taxes paid into the kitty to not have to pay underpayment penalties and interest out there. Is that is
Yeah.
that the
And I think for
spiel?
our clients, we start Q1, we start everyone pretty much safe harbored for the year because we don't have a lot of historical information as to what's going to happen for the year, even though they may say this is going to be an up year or down year. So we usually look at the safe harbor amount for Q1 just to be safe. But now we're moving into Q2 and we're looking at the annualized income. So we really try to be as accurate as possible for our clients, as best as we can to try and get them the closest amount to what's really going to be owed, knowing that it's going to be variable. And of course, we talk to our clients about it as well. But um,
Yeah, and we want our clients to pay as little as they're required to pay, but understand the full picture of what they're going to need to pay based on kind of what they're doing out there. Just so again, like the IRS isn't going to give you interest for paying early. So you don't want to pay early, but you do want to be able to predict your future cash flow. And so, like, we have a question as an S corp owner focused on maximizing debt service. What strategies would you recommend to manage tax liabilities effectively while protecting shareholders from phantom income tax payments? And that's like kind of goes into this of like paying. So, what they're saying is like, hey, we're paying down a bunch of debt and we're trying to pay the interest, which we have to pay and we get to deduct, but we're also making principal payments, which are investments. Well, when you pay down the principal of debt, you don't get a deduction out there. So if I make $1 million and I'm going to owe 350 of taxes in my example, and but I have $1 million of cash, if I take 800,000 or $750,000 of that cash and go pay down debt principal, now I don't have enough money to pay my taxes. So there's not an easy way to manage that other than to manage it, to understand, you know, there's a cash flow statement and there's an income statement. And even with your like income statement, you have to go make a couple of adjustments to get from taxable income or to get to the taxable income and to the tax you're going to owe. And that's kind of what we do for our clients on a quarterly basis. And so we get to say, look, dear client, you started the quarter with $100,000 in the bank, and today you have $400,000, but you earned, so that's $300,000 of accrued cash, but you really earned 150 because you placed this asset into service and took a loan out, or you really made 500 because you have some, you know, um, kind of earned income that you haven't. Oh, because you made a distribution already of $200,000, so you made 500, but you've only increased your tax by 300. Like that's just a kind of odd example, but like to manage your tax burden and your debt service, you just have to understand those two numbers of like what is your net taxable income and how much cash have you accrued, and are you uh are you going to shortchange yourself? So
and we're going to send at the end of this, we have a link to reach out to us if you want more information, if we want to go any of these kind of more specific scenarios around, real information. You can always chat with us and we can go into things with
Sure.
more detail. I did miss a slide and I wanted to just mention that while we don't want you to pay the IRS more than you have to, the IRS has gotten a little bit more aggressive about underpayment penalties. Um, and so, where in past years we've had clients who've been like, I can earn more than I will be charged in interest. I'm not giving the government a dime. We've had a
Yeah.
number of those clients. We're having to call them up and say, just be careful because, you know, if you can earn more than 7%, it's just getting dicier now that the number's getting a bit more aggressive. So we have
Yeah,
a
it's always the real estate guys, and they were pumped up. Yeah, ZERP was kind to everybody when the IRS was charging 4%. People thought they could beat that hurdle, but now you even call aggressive people and go, "Hey, it's 7% or it's 8%." Like, just so you know, that's the pref, and they go, "Oh, that's tough." So yeah, you don't. My first boss, Sam Gaynor, said, "I'd rather owe my grandmother money than the IRS," and it wasn't like that for a year or two, but it's just back to you don't want to. The IRS is the lender of last resort.
and we have a key tax deadline calendar you can subscribe to, and that will put it on your calendar and give you some notes for things to note it, for you to keep an eye on throughout the year.
Killer.
Um, okay, back to mid-year. So now we've moved past the quarter and now we're looking at kind of what do you need to be doing moving into the second half of the year.
We're halfway there. So yeah, it's kind of back to what I was saying just a moment ago. It's hey, we're halfway through the year. Let's look at our P&L. Let's look at our cash flow. Let's start to see if we've made $500,000 of taxable income, but we only have 300 grand of cash, what are those differences? What's happened out there? How are we projecting, this year based on past years? What are the next 26 weeks look like? What's capital investments we need to make and equipment we need to replace, debt that's coming due, you know, eh, collectibles that we need to take in. I mean, it's a great time. Like, it just in like the main CPA firm, we run a pretty like calendar year business. I mean, if X months from now, you're about to send out a bunch of contracts. If you have any seasonality in your business, now's the time to go, hey, I was talking to a guy who runs a HVAC business and they're ramping into summer. I mean, it's about to get crazy. And I was like, now's the time to go put everyone on contracts. If you want to go do that, if you want to sign people up for the annual maintenance plan, you got them right where they need you. If you come to my house today and say, "Hey, by the way, not for nothing, let me come out. I'm here today, but I'll also come out in November and March," and you hit me up for that monthly fee, you're gonna get me because I just want my filters changed, and I'm a moron. So, these are wherever your business is in the annual cycle and in the kind of cash conversion cycle and in the uh, kind of business cycle, you think about that. And then obviously taxes are on a pretty calendar year cycle. And so from a tax standpoint, it's just the time to check in and say, hey, where are we at? Like, this is the June 15th estimated payment. It's ES2. You make the first one with your extension in April, then you have June, then you have September, and then you have January. So whenever I'm working on these with clients, I'm always just telling them, hey, this is like, if you're going to mess one up, let's mess this one up because we still have time to catch up. So, like, this is the time of year where you can really kind of get back on track and get a mulligan more so than you get to November and you start trying to make things happen, and it's pretty tough. So, yeah, we look at this is a good time of year to look at entity structure. You probably have time to kind of ram changes back to January, or move big things. Yeah, I mean, an S corp election. Look, you can make an S corp election when you file your taxes in September of next year, but again, I'd rather at least be knowing that I'm gonna do the S corp today, because then we can get the salary set up, and then we can go start to, get the 401k set up, optimized for QBI. Like, we had a client, we looked at him the other day and basically said, "Oh, you're gonna do the S corp? Stop paying yourself a salary for the rest of the year. You're already, like, overpaid on salary. And here's what we're going to do. We're going to make these distributions, and we're going to set this S corp up, and we're going to do this, and we're going to save the principals of this company hundreds of thousands of dollars through qualified business income deductions, just because we caught it now, versus if we had done that, if it were February of next year, they would lose a couple of hundred grand, and we're not charging them that much to fix it all. So
Yeah, we've actually sent out, I think, 5 selection forms today, this week, because it's the time. We've talked to people, we understand what their revenue is looking like. We kind of have a litmus test, a smell test of what an S corp like becomes valuable from a tax savings perspective. And I'll run to the next slide because we do talk a lot about pro cons of S corps, and I talk a lot about the PETA tax of having to file a separate return, set up payroll. Like, there are things you're needing to track your business expenses and be much more, if you can, precise about things, because you're putting it all into a separate tax return. But the tax savings are not insignificant for most folks, and we're doing it now where it's like, hey, go ahead and take the S election. Let's go ahead and get your payroll set up at some point over the summer, because the last thing you want to do is come up to the end of the year, not have payroll set up. You're trying to fill out state level forms and get things going with getting everything, all the I's dotted and T's crossed, and then you miss your date. And we had a few people miss dates last year. They waited and waited and waited, and then once December 31st, the clock strikes midnight, like, there's no turning back on issuing payroll. There's nothing you can do to make that unhappen. So
yeah,
we really try to get our clients think about what makes the most sense from a financial perspective. What's the best tax strategy for the business structure? We do have a number of clients that have partnerships and S corps and have a lot of things in their wheelhouse, but it's a good time to think about it and to know about it, because uh, we love S corps here. I say that I'm like the Oprah of S corps, giving them away, because they're just a really great option for folks to save taxes when it fits their need.
totally. Um, So yeah, and by the way, they hit the Q&A button at the bottom. Ask anything that you know y- comes up. If we're going too fast on something, if something doesn't make sense, I talk about this stuff all day, so I have to stop myself and remember to clarify and slow down. So anything that you have, we're right here to answer questions. So yeah, here's a great case study, and this is something we see off. I mean, this is right in the wheelhouse of the kind of like better bookkeeping client that's out there today. Is they come in. This is our favorite type of client. They just walk in and they say, "Hey, I'm making $400,000 a year. My business doesn't really have any expenses, and we ratchet them up to 40,000 of expenses between home office and professional fees and uh, you know automobile usage and medical insurance deductions, and they but a lot of people have these good businesses where they make good money and don't have a terrible amount of expenses, and then get to 350 net like this, and we get to just show them what they're dealing with. The self-employment tax is a killer. They come in, saying, "Hey, um I'm paying out the I'm paying self-employment tax, FIDA, FUCA, Medicaid, Medicare, that's 15.3, that goes all the way up to, almost $175,000 today. And then beyond that, they're paying 3.8% Medicare tax all the way up to infinity. And then for a lot of them are phasing out of the qualified business income deduction that's out there today. So, with this person, they're a consultant. That's a specialty service trade business, which means they can't get the qualified business deduction when they phase out of a certain income level. I think this is a single person too. And so we're not even talking about, yeah, QBI and trying to optimize for this 20% out there with their salary. All we did with this person is saved a little bit of FIDA, FUCA, Medicaid, Medicare, and it saved the 3.8% Medicare tax between the 150 of salary and the 360 of net. So that's, they go from owing 126 to 117. And really that whole $8,000 is just basically 3.8 times $210,000. And so, you know, not all of these take the same shape. Like this is one little scenario of a person where we saved them $8,000, like totally legally. This isn't like gray area. This is a legitimate way to set up your business to just not pay 3.8% on all of your earnings. And, you know, we know like 50 of these things. Every client that comes in, we basically score them on this game plan rubric of like, how are they set up? Who are they? What are they doing? Are they growing? Are they shrinking? Are they going to sell their business? Are they going to run their business forever? Are they going to take partners? Are they not going to take partners? Do they live in California? Are they going to leave California? Are they going to move to California? Like these are the kind of like diagnostics we try to run on you and your business when you walk in the door. And then we kind of, take your current plan and build on top of it or move it around a little bit or just build a plan from scratch for you. And, this person, we go, hey, you're in Texas, set up a Texas LLC. We'll elect for that to be an S corp. Here's how you pay yourself. Here's, you know, also the S corp offers a lot of retirement plans, which we'll talk about in a little bit. But that was good for this person as well. That's not even shown here. So Evan, show 'em our. So that QR code will get you to our S corp calculator, which you could run this exact scenario and see that benefit. Um, yeah, and even this is the site. Evan, the next slide, I think I threw in the outcome of, or this is, I guess it didn't work. Dang. Um, oh, you're just on a different version of the slide deck. But yeah, the little S corp calculator, if you put, hey, the business is 360 a profit and the salary is 150 and it's consulting and they're single, you would just get to that answer. So yeah, a
Yeah,
little bit of,
one of the questions we got was, what is the sweet spot of, for, the S corp? When is it worth the hassle? What's the return on hassle? And we usually say around 50K of net profit. But I was going to say, go and check out the S corp calculator. You can put in your own kind of levers and see what makes sense for you, and it'll send it to you. And it's a good way to just decide when it actually, if you go too low, sometimes you'll look and it'll say may not make sense for you yet. And we actually have a number of clients where they are starting up brand new businesses and they're like, when does it make sense? And we're keeping our eyes on it this year to say, is it going to make sense to do that before the end of the year? Yes or no? Because there are additional things you have to think of and things you have to do with an S corp. But I would say 9 times out of 10, the juice is going to be worth the squeeze.
Yeah, it's just watchful waiting. Like, you know, for us, we just, yeah, that's, we keep an eye on stuff like this for our clients. And again, a lot of our clients come in and are just not set up. And yeah, that the big benefit of an S corp, there's several kind of like tracks to go down, but the idea is that, when you weren't an S corp, when you were just self-employed filing a Schedule C, you're just paying self-employment tax on every dollar you make. And sometimes it's pretty inefficient from a qualified business income perspective. And what we do when you're an S corp is we essentially bifurcate your ownership activities from your payroll activities. And so we pay you less than the business makes, and we allowed the business to earn a profit outside of the kind of direct labor of the owner. I always talk about it in terms of like a franchise concept of like, if I were starting a McDonald's tomorrow, I'm charged with securing the site, getting the franchise agreement, hiring a contractor, building the building, getting the whole operation running and in place. And that's mostly owner activity. That's not employee activity. But then let's just say I also ran the counter and ran the drive-through and flipped the burgers. Well, that's employee activity. So what I would want to do is bifurcate the $400,000 or the $360,000 I ended up making net from this whole business into what is the employee activity, meaning what would I pay someone else to do the work for me versus what is the business profit out there. Because you know business income, you get the QBI deduction. Business income not subject to Medicare tax, not subject to self-employment tax, but still allows you to go in and make matching contributions for 401ks, set up defined benefit plans, make investments in things like real estate and all that.
So quick reminder, there's this little QR code here will take you to the calculator. So definitely go check it out. We get the also question quite a bit is what is a reasonable salary? The calculator does kind of lay out a little bit of a reasonable salary, but we do we just want to kind of give you some ideas on what does it mean to have a smart salary. Because as
Yeah.
Mitchell mentioned, like we had a client who came to us and said, made a lot of money. They're like, I want to pay myself a $330,000 salary so that I can max out my 401k and I want to do all these different things. And we did a side by side and we're like, okay, yes, you can do that, but here's how much more you're paying in payroll tax. Like versus if you just take the reasonable kind of optimized salary, you could save some money there. And so kind of thinking through the side by side, there's a number of reasons. There're different reasons to pay yourself varying amounts. And there's some salary sweet spots that are in here, kind of where you can see the Social Security changes and the Medicaid, Medicare, as well as QBI. And QBI is the one that we really focus quite a bit on because that's like one of the best deductions for S corps. Um,
For
but
high
yeah,
earning S corps, it takes your tax rate effectively from, or your marginal tax rate from 37% to like 29%. So it's massive for so
yeah, we literally did that for one of our clients. Came back and they I think did a shout out for us and was like, we're like, hey, our tax rate went down to 29%. And as Mitchell mentioned earlier, this is all like 100% legal, above board. You just have to know how to do it. And that's where it gets a little complicated, and knowing how to pull and optimize and pull the right levers. But setting the right salary and really thinking about, and we do this at the end of the year for a lot of our clients. We want to take in real history for what's actually happened. We want to know how much money did they truly earn? Did we get all the expenses? This is why it's really beneficial to have ongoing bookkeeping, because we're not chasing our tails trying to figure this out. on December 27th, right? Between Christmas and New Year's when everyone wants to be taking a nap. You're trying to maximize your QBI deduction.
Oh my
So
gosh. I had a client once, like, set up an LLC, set up a 401k plan, set up a gusto plan, pay themselves, do this all like on December 30th. And I almost I lost a year of my life. So
yeah,
yeah.
it's rough. But the idea though is we do come back at the beginning of December and we run a calculation to see what is an optimal salary for our clients. So just trying to make sure we're maximizing the QBI deduction, make sure that if we've had them kind of pay slow and steady throughout the year and then they've earned some big Q4 numbers, just to make sure everyone is rightly um, maximized for the best salary. So just keeping that in mind, you have time to make these changes throughout the year. If you're overpaying, we have had some clients where we're like, hey, you're paying yourself too much. Let's dial that back. And if we need to come at the end of the year and create a bonus payroll or something like that to try and help to get you optimized. But we don't want to overpay on payroll tax. We don't want to overpay on some of these things. We want to find the kind of Goldilocks sweet spot on all of these different moving pieces.
Yeah.
The other big thing to be thinking about now, and Mitchell mentioned this earlier, is going ahead and getting your expenses in the right place. Are you have you been tracking everything? Do you need to defer anything for next year? A lot of our clients come to us and say, hey, should I go buy some equipment? Should I buy a car and do advanced depreciation? Um, I always go back to them and ask, are you having a bigger year next year? Because if your year is going to be bigger, or if you're expecting more of the same, don't shoot your future self in the foot now. But if you know that this year is really big and you've had some unexpected income come in, and go ahead and buy things ahead of time, or do prepayments for services or marketing or whatever those things are. We just want to keep those things in balance with how your future self is going to be making and earning money.
Yeah, it comes down to there's this concept of like lifetime effective tax rate. And if you're having a big, big, big year and income wise, you want to match deductions to that big income year. If you're having an ordinary year, really it's just how can, well, I had a client who put a big piece of property into service and, basically said, oh, this is great. I'm going to be at zero taxes for the year. And I was like, you know, not for nothing, don't wanna seem like a jerk, but that's not that great because you're gonna make $500,000 a year for the rest of your life, and or as long as I've known you, you've made $500,000 a year, and for there's no trade-off in the foreseeable future. So I know you're gonna get this $1.5 million deduction this year, but you don't really wanna go negative if you can avoid it, and he had the ability to pull forward all this income and do a bunch of maneuvering and do a bunch of Roth conversions and have a bunch of different things happen to not make himself go negative, but to just make himself show $250,000. And he had the ability to kind of spread out the deductions over time. So instead of having like a negative $250,000 a year, he's going to have a $250,000 a year for the next few years, which is a better outcome and a better way to kind of like feather the payments because he's got a bunch of kids, married couples with 3 kids in Texas who make $250,000 don't pay taxes the same way that people who make $500,000 or $1 million pay because you're just in the 24% bracket and you're not in the 35%, 37% bracket. So but, he got to utilize all those low brackets and kind of optimize not for just this year and not for just having 1 year where he had this big old loss, but he got to think forward a little bit more. And, just kinda jumping off on this, just back to this mid-year concept of, like, if we're gonna optimize. we get so many people in June who are like, I have an extension. I need you to do my 2024 taxes. And like, we do that for people, but it's just like, you're so much better off getting your books caught up and getting your life organized right now. Cause then you get to like, you're going to pay the same amount to keep it updated on an ongoing recurring basis or to slam it all through and one shot catch it all up. And the real loss is like you just don't get the insights into your business the whole way through that you would get if you had like real books, if you were getting the monthly email, hey, your books are closed, here's your P&L, versus just handing us 4 credit cards and having us try to parse through what's personal and what's business and weave it all together. It's just uh
Yeah.
it's an objectively worse experience for everyone.
We signed a new client, about 6 weeks ago or so, and they didn't have an S election and didn't have things in place for last year, and had all of their expenses on tons of different accounts. And there was an Apple Card and yeah, other things, kind of where there was mixed between personal and business. And we're trying to file, and then they needed to file their taxes because they want to buy a house. So they had an extension, but the house is not buying, it's not going to wait, it's waiting for nobody. So we had to kind of hustle and figure it out. And by the end of it, they're like, oh, just forget it, we don't need to worry about the Apple Card. And it's like, I went through the statement, and it was $20,000 a month of stuff, and it's like, is some of that business? So we just really recommend trying to keep these expenses through your business, keeping everything in one place. Get a credit card, get a business card, get a checking account. If it's not a business per se card, that's fine too. Just designate a personal card and really just use it for your business expenses. Um, it'll make your life so much easier. And the amount of stress that we relieve from people just by giving them this clarity it's I get these big sighs of relief when we get someone onboarded, because they're like, I don't have to worry about this anymore. And it's like, no, you don't. And people still here and there will be like, oh no, I used my personal card to book my flight on this business trip. And it's like, totally fine. That's totally doable. And we can make that's an easy fix for us. It's just more where everything is commingled, and everything is nice and messy, that it makes it challenging. These are the things, these key expenses that are laid out here are the ones that are here to, go through your business. You can deduct salaries, you can put things like rent, travel, 50% of meals, any of the marketing things you do, your website you purchase, everything that you buy equipment wise. And if you go into conferences, there's a bunch of things that are on this list that you can, sorry, my dog.
So
Mitchell, where did you
yeah,
go? You jumped off the screen too, so I don't know what's happening over here. It's like we're falling apart. Sorry.
I don't know.
Um,
It's over. There we go.
Mitchell, we see your ceiling. So anyway, these are things to keep in mind. We want, best practices: open a business checking account, get a business card. Obviously we want you to keep records of everything. But in worst case scenario, hire someone to do it. And we're here for it. Better Bookkeeping is, that's what we do for our clients every day. I always tell people we classify transactions daily. We send out reports monthly. We do quarterly tax planning quarterly. We do end of year salary optimization, and then we file your taxes. And we have our finger on the pulse. It's a monthly service because we want to be looking at all of these things on a monthly basis. We're getting
And
close
we
to
stand
time.
by, I mean, we stand by on anything that comes up, we're here. We take care of the clients. Yeah. So,
Um, just as a final reminder, if y'all do have any questions, we're here to answer them. We're kind of heading towards the finish line of retirement and benefits planning, and there's not this is kind of our last little section. But if you think of anything that you have questions for us, we can spend some time going through those. And then otherwise, like we mentioned, we're going to send this out. We are also beyond available to answer questions for your specific business use cases, or things that maybe you're like, hey, I want to learn more about this. I also think we're going to send out a check, like an actual physical checklist on some of these things, just to make sure, you thought through them and said, are these the things that I need to be doing before, as like a mid-year health check. The thing about retirement and benefits, there's pros and cons to it, but the thing you have to do and make sure you keep in mind is that if you're going to try and do any kind of retirement and planning, and you want to set up a savings account, for a lot of these things, you don't have to pay, every 2 weeks. You don't have to set aside retirement money and set retirement funds. You can do that when you file your taxes, but you have to have an account set up. So those are things to just really keep in mind. If you want to do all of these things, there's pros and cons for HSAs and pros and cons for the IRA versus SEP IRA versus a solo 1K. You really have to kind of figure out what's right for you. And we help with our clients on making those choices. But the biggest thing is you have until April 15th to fund an account, but you really have to have it open in place, and ready to rock and roll before the end of the year. So the big things, make sure you have payroll set up before the end of the year. You have to make sure you have an account for retirement set up. You don't have to have everything, totally done throughout the year. But these are things to be thinking about before it's too late into the end of the year.
And, it's really personal as to which retirement plan is right for me. I mean, a lot of people who come in without S corps, they're using SEPs, and when we convert them to an S corp, a 401k might make more sense. If you have employees, the whole game changes. A bunch of people say, "Well, we want to do this whole groovy retirement plan, and we want to do this defined benefit plan, and I heard you can put $200,000 a year away." And I'm like, "Well, you have 52 employees, sir, so you can't, there's this thing, ERISA, and they don't want the doctors to all be on Cadillac benefits and Cadillac retirement plans, and the nurses to be on Ford Pinto benefits and retirement plans." So retirement planning is a very personal thing based on time frame, goals, wants, needs, objectives, and situations. And so, we walk through that scenario with our clients out there and give them all kind of specific advice. And then we don't manage retirement plans at all. We work with only outside vendors, and so we help make introductions and manage those vendor relationships out there.
So quick slide just to kind of lay out the difference between 401k and IRA. We had a client who came to us a couple of weeks ago and said, I'm about to hire my first full-time employee. Awesome. But you have a solo 401k. So
Yeah,
can't do that anymore. We had to kind of do a quick,
it's time to wind it down.
yeah, you
Yeah.
can't have it all in place. And so there's definitely things to think about. Again, a great time of the year to be thinking through those, because um, and it's amazing how many of our clients are now making hiring decisions and are ready to bring on employees or do different things. So it's all just very, like Mitchell said, very personal as to what makes the most sense for you and for your business and for the benefits that you want to offer to your employees and to yourself. Um, so
Oh,
this
we
kind
made
of
it.
it was a little wild the last 10 minutes, but and apologies for that. But hopefully this has been helpful for you guys. As I've mentioned, we're running a special. If you sign up before July 1st, we are doing no catch-up fees for 2025. We are still taking on 2024 clients, and doing who have extensions. We've been bringing on a few new ones that are needing their tax returns to be finished and doing book cleanup and things like that. So if you need us, we're here to help, and appreciate all of your time.